In 2008, a bank collapsed in America and, creating a domino effect, brought the whole world down. But the real question is this: how did something called a home loan turn into a global catastrophe? In this video, I will explain what happened within 10 days, who hid what, and why we still feel its impact even today. Let's get started. In the early 2000s in America, owning a home was marketed not just as a dream, but almost as a right. Ads and banks gave the same message: instead of paying rent, pay the installments on your own home. Moreover, it was presented as if a large down payment or a flawless income history was not required for this. Interest rates were kept low at first, payments looked easy in the first years, and since home prices were constantly rising, people thought, it's gaining value anyway. Thus, housing stopped being a place bought to live in and turned into an investment game that everyone joined. Buy today, sell for more tomorrow. The system lowered the bar a little more each time to pull more people inside. And what's really interesting is this: after banks gave out these loans, the risk didn't stay with them. The risk began to be sold like a product. At a certain point, banks stopped being institutions that kept the home loans they issued in their vaults. The logic was this: the bank gives the loan, and then, instead of holding on to these loans one by one, it gathered thousands of them together and sold them to investors as if they were a package. Think of it like a loan box. Inside, there are hundreds of different home loans. Some are solid, some are risky. But when the box is wrapped nicely, it looks like a safe product to someone looking from the outside. When the investor buys this box, the bank's risk decreases, and the bank relaxes and hands out even more loans. The problem is this: as the box grows, the risky loans inside increase, but a high-quality label could still be stuck on the packaging. And while everyone was buying and selling these boxes, the real question was being forgotten. Would the people who took these loans be able to keep paying a few years later? Right here, everyone asked this: is this package safe? The answer was tied to a single label, and that label was enough to convince millions. The most critical part starts here. For these loan boxes to be sold to investors, a grade had to be stuck on them, just like a school report card. And this was done by the rating agencies. Normally, this grade should have been the answer to the question, how safe is this product? But in practice, the system worked in reverse. The packages were so complex that the risk inside was presented as if it had been spread out with mathematics. When you put a few solid loans next to a large number of troubled loans and said, there is diversification, it looked as if the danger was disappearing. As a result, some packages were able to receive the top grade, the AAA label, even though there was serious risk inside. Because of this label, most investors assumed it was as safe as government bonds, and bought in with large sums of money. Yet AAA here did not represent real trust, but the illusion of trust, and with a small crack, the whole building was going to shake all at once. On paper, everything was flawless. But the system's survival depended on one single thing: people continuing to pay. And when that day came, the first domino fell for the first time. Then the crack stopped being invisible. When interest rates rose or when the low payment of the first years ended, many people began to be unable to make their payments. First came delays, then defaults increased. As homes were foreclosed, the houses piled onto the market pushed prices down. When prices fell, people also lost the chance to save themselves by selling their homes, because now the value of the home was dropping below the debt. At this point, the issue was not just loans aren't being paid. The real disaster was the collapse of trust. Banks stopped lending to each other, because no one knew how much risk was inside the packages anyone was holding. And that chain of distrust turned into a symbol in September 2008. Lehman Brothers collapsed. In that moment, the markets understood this. This time, someone really won't be saved. Panic spread, the flow of money locked up, and the crisis turned from a few bad loans into a global freeze. Lehman's collapse was a result, but the real question was this: who's next now? Because that night, the markets faced one single thing. This time, no one trusted anyone. After Lehman's collapse, governments and central banks realized one thing. The problem was not just a few banks failing, it was the circulation of money stopping. When banks stopped trusting each other, they cut off lending. Companies couldn't find financing, people reduced spending, and the economy basically locked up. That's why rescue packages and the liquidity injected into the markets by central banks came into play. The goal was to get the system running again, to open up those clogged arteries. But the cost was heavy. As demand fell, production slowed, businesses shrank, and unemployment rose rapidly. For many families, the crisis was not just the graphs on a screen, but directly job loss and debt pressure. In the markets, fear was priced in. When everyone rushed to cash at the same time, assets lost value quickly, and the wave of panic crossed national borders and spread across the whole world. In short, the bailouts kept the system standing, but the bill stayed on society's back for years. The system seemed to start working again, but the bill was only just coming due. Because the crisis wasn't over, it had only changed shape. When we come to today, the impact of 2008 is still on the table, because after the crisis the world learned this. Housing is not just a home, but also the first link of a huge financial chain. When interest rates fall, credit becomes cheaper, demand increases, and prices rise. When interest rates rise, the opposite happens, installments become heavier, buyers decrease, and prices come under pressure. That's why when we talk about the housing market today, we are actually talking about interest rate policy, banks' appetite for lending, and the pulse of the economy. On the banking side, regulations tightened, capital and oversight increased, but risk did not disappear completely, it only changed shape. New products, new intermediaries, new safe packaging were emerging. So the answer to the question of whether the crisis will repeat was not a single word. The same film may not come back exactly the same, but when conditions form, easy credit, excessive optimism, and the belief that this time is different can come together, and a similar story can be written again under another name. And this is where the most dangerous sentence begins: this time is different. History didn't really forgive those who loved that sentence. Let's end our video with 3 clear lessons. First, risk doesn't disappear, it only changes hands. When the bank issued the loan, the risk was there. When it was packaged and sold, it didn't vanish, it was only spread to more people and became invisible. Second, labels like AAA are not the truth itself, they are the stamp of an opinion. When people trusted the ratings too much, they stopped asking their own questions. Who is paying this money, and what would make them unable to pay? Third, trust is the fuel of finance. The moment trust is gone, even the most solid-looking system can lock up. If this gave you a new perspective, don't forget to like the video and subscribe. History speaks. Those who listen win. Stay well.